This episode was brought to you by Google Cloud, a partner that needs no introduction. What you might not have heard of, though, is that Google offers a Google for Startups cloud program where they give you access to startup experts, technical training, business support, and cover your Google Cloud costs up to $200,000 for 2 years, or even $350,000 if you're an AI startup. Scale your startup faster and smarter with Google Cloud. Head over to goo.gle/Swisspreneur.
If you look at the traditional way of getting a car, you used to go to a dealer, buy the car, you have a different party to finance the car, then you have a different party who insures the car, additional partners for tire changes, maintenance, repair, all these different topics basically, and you have to want to be knowledgeable about it and also manage it to a certain extent. So what we're offering is very convenient and simple access. You go online, you find the car, you book it in 2 to 3 minutes, you get it delivered to your doorstep, and we take care of everything that can happen basically.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. If you enjoy listening to our show, make sure to follow the podcast and leave a rating. And now, here's your host, Sylvan.
Nikolai, a very well welcome to the Swisspreneur Show. It's a pleasure to have you as a guest today.
Hi, Sylvain. Thank you for the invitation. Great to be here.
You're the co-founder and COO at Finn, a car subscription startup coming from our brother in the north, from Germany. Before we talk about how you got into the car business, I actually want to learn a bit more about your personal background. After finishing your master's degree, you went on to work for the Boston Consulting Group for 3 years before then quitting your job and building Finn full-time. So I wonder, what about corporate life did not quite suit you?
Well, that's an interesting question, and I guess also a question I get often asked from applicants and from people in my team, etc., especially young people that probably have the same decision ahead of them, especially consulting versus startup is an often asked question. For me, it was a super interesting experience, and I really enjoyed my time at BCG. I had great colleagues. I had interesting projects I worked on. However, it didn't really feel like, this was going to be the job I wanted to do for the rest of my life. In the end, you're just an advisor. Basically, you jump from project to project, but you never are really part of the execution of anything that you develop. And I guess this is an answer that most former consultants would tell you. But I think I would generally describe me as a quite hands-on person, and I like that operational aspect, basically, and getting my own hands dirty. As a consultant, you're in the end always working conceptually. So most of the time, your work product is a PowerPoint slide, is an Excel model, etc. And for me, it was just not tangible enough. And the second part for me was also to be more self-dependent in the end, and at some point be my own boss. I think you might be able to in a certain extent achieve that in a consulting company as well by becoming a partner. But in the end, you're still an advisor, and you still basically do what other people ask you to do, and you never basically are able to really set your own agenda. At least that's how it felt to me. I never became a partner, so I cannot tell if this is also. So generally, it didn't feel like I was going to be motivated to do this for the rest of my life, especially with the career progression in a consulting company, moving more to a sales role. I didn't really see this for myself, and was very intrigued to become more self-dependent and also start a business in the end. So I was quite actively looking for opportunities to get in the startup environment.
Fantastic. And at the same time, I assume that this also comes with a cost, right? You probably were on a great career trajectory with a nice salary and some nice other perks coming from the corporate world. Was that also a tough decision financially to then switch over and basically become your own boss and start a company?
Actually, this was not the main part of my consideration back then, because also looking backward, it would be different by now with having a family. But back then I was quite independent and my fixed costs were rather slim. So there was not too much to lose. And also to a certain extent, I felt that there's always going to be an opportunity in consulting. So if it wouldn't have worked out basically with our own company, Finn, then I felt like the way back into a consulting role doors would be always open for me. So I never really was worried about the financial implications of that. And I think the second part of it, when we started Fin quite early, we also basically brought investors in. So it's not that we developed the product for years basically and didn't pay ourselves any salary, but basically quite early on, we were able to actually pay ourselves a salary as well. So the setback was not that hard actually back then.
Sounds like the perfect setup to get started in that regard. And I wonder, where does your entrepreneurial drive come from? Did you have any entrepreneurs in the family that motivated you to start your own business? Or was that just something you were always dreaming of to do eventually?
Actually, no, not really. No one in my family is running a business, or I'm not from a family basically with a lot of company background. So for me, it was basically intrinsic motivation, I would say, to a certain extent, to build something that is also to a certain extent lasting, to have an impact, to become an employer, basically. And for me, always the end goal was to become independent more or less. On one side financially, but as I mentioned, on the other side also to be my own boss and basically define for myself basically what I wanted to work on, what I wanted to spend my time on. So it was super appealing, and I think entrepreneurship, in my opinion, is still probably the most attractive way to actually get there. Most of the hopes I had back then actually paid off, and I'm quite happy I took that decision back then.
I love that. A very personal life decision, so to speak. And you did start the company Fin in 2019. You started out with 6 co-founders in total. How did you meet your co-founders?
We were probably not the typical startup story. So we were not, we didn't know each other from university and had this great idea overnight and started to build or decided to build a company around that. Actually, in the early days, we more or less met around Picos Capital back then, our very first investor. And I think we already quite early on, after basically having the idea back then and also having the backing from Picos, looked at, hey, what does it take to build this company? What would the organizational design actually look like? And then quite actively try to find suitable profiles, basically, that could fill these roles. So from the very beginning, we had a clear idea of, hey, this is what our org will look like, and these are going to be the profiles that we will need for this. So it was to a certain extent also actively trying to find the right co-founders in order to just have a broad skill set and be able to cover the most important aspects of our business, ranging from sourcing vehicles to financing vehicles, over operations, basically.
Well, that's super cool and something that we rarely hear on the podcast. Usually it is the traditional university story that you just mentioned. So I'm very curious to learn a bit more about that. What were the sort of the 6 functions that you wanted to start out with that also made it necessary for Fin to have 6 co-founders to start with?
Mm-hmm. So obviously we had a CEO, which is basically the overarching responsibility, mainly responsible for fundraising also at that point. But next to that are the functions that we had and to a certain extent still have until today. So the function or the organization is still in place until today. We had the user acquisition part of it. So basically the demand side of things. Where we had a co-founder. We had the supply side of things, which is in our context mainly sourcing vehicles. So we had someone with industry experience coming from a large rental car company who's done exactly that basically, and also had the very important access and the phone book basically at the different manufacturers and OEMs to enable the first deals, etc. Financing for sure plays a very important role, not only as another company like the typical topics around accounting, etc., but in our context, being a startup, equity financing, as I mentioned, is one important component, but then also the asset-heavy nature of the business requires significant amount of debt financing to actually finance the fleet, the vehicles themselves. So we had one co-founder that joined as CFO responsible for finance, me for operations. So this is basically where supply and demand come together. We more or less are responsible for the entire car and vehicle journey at Fin and the operational processing of this. And then as we consider ourselves a tech-enabled company, obviously also our CTO, who joined back then from a large other e-commerce company, West Wing back then, was super important to basically make sure from the very beginning we had this tech enablement approach in the business, which is until today, I think, one of the key components that actually ensures our scalability, basically.
And this sounds like a very strategic approach, which I like because it seems to really fit your business and your business model at the same time. However, when you know each other from university, usually you have a bit more of a background, right? You know, not only on a skill basis, what you could probably have evaluated of every co-founder very thoroughly, but you also have the whole value set. Do we work well together? Do we get along well together as human beings, basically? How do you test for that component without having this sort of longer work or study relationship?
I agree, and it's quite surprising actually that up until today, the majority of the co-founders are still within their role or at least part of the business. So I think to a certain extent we did something right back then. I think being just a friend, a group of friends, basically can also be quite challenging or dangerous actually to a certain extent because you have those personal ties, etc. So I think for us, how did we test for this is an interesting question. I think to a certain extent it's also gut feeling and based on the initial conversations, but you cannot be as sure as if you would be knowing someone for years, basically. So this was very important. But in the end, it's about figuring out in the initial conversations, do we share the same values as you mentioned? Do we have the same, basically, also idea of how to build a company? Do we want to achieve the same things? Are we equally ambitious? What are our plans, basically, for the upcoming years? And I think, as mentioned, the fact that most of my co-founders are still around actually proves that we weren't too off back then. Because I think we get along well on a private level, basically, but it's not like that we spend the majority of our basically spare time also together. And I think this is very healthy because it also allows you to have more healthy conflicts, probably in a work-related context, not being too close, not being friends or family. And I think this is also how we looked at the company back then, that a company is not necessarily a family. It's like a team, in our opinion, more that wants to achieve similar things together.
Absolutely. Fully agree. And I assume you probably also put some protective measurements in place that in case one of the 6 co-founders would not work out, that the shares, the most valuable asset of the company, especially in these early days, would be protected so that you would also have a good leaving in that sense to not jeopardize the future of the company.
No, absolutely. But I think we did what most other startups do. The most important protection there is our vesting period for sure. And everyone, also the co-founders, but also every other employee that joined after, had more or less the same conditions and the same vesting period. But I think this is also a pre-requirement, basically, of every VC joining the team quite early on, that they know, basically, if someone leaves, that they will not be fully vested from day one, basically.
Absolutely. That's standard good practices in that sense.
I agree.
Now, talking about the actual product, you offer car subscriptions. So I wonder, how did you get into car subscriptions in the first place, and the whole idea to create and generate a business around that? Was it any personal experience that sort of triggered this, or was it also a very strategic process as with the co-founders?
I think it was a combination of both. Most of us had their personal experience with, for example, getting a car abroad, being on a semester abroad, trying to rent a car, or buying a used car, and actually figuring or witnessing basically all the struggles that come along with that. But I think to a certain extent, it was also quite strategic process of looking at the unit economics where that makes sense, but also analyzing different industries. And what we found very interesting in the car industry, and why we basically we're very convinced by the idea of car subscription, is that it is basically combining a lot of different trends that go on in the automotive industry at the moment in parallel. One of them certainly being kind of this transition from owning a car to using a car. So we see increasing rates of leasing, for example, which is a good indication for that. We see a product like car subscription functioning well, and less people actually outright purchase a car. not only car, actually also other financing heavy assets. The second component was this e-commerce trend. And actually in the automotive industry, a large fraction of the business still happens in a very offline fashion, like the classical way you go to an offline dealer and basically talk with the guy there, or you buy or lease your car basically via dealer. But just a fraction of the entire market happens actually online. I think it's 1 or 2% at the moment. So we figured that this trend that we've seen in other verticals already, this move from offline to online, will happen in the automotive industry as well over the upcoming years. And it's very cool to be basically early part of this and actually also enable this. And the third part, and this is also a very important aspect of Finn, is I think this entire transition of drivetrains at the moment. So the electrification of the industry from combustion engines to electric vehicles is something that we very early on also pointed out as one of the key topics that we wanted to be strong in, because we believe there's a lot of uncertainty among consumers around electric cars, and many are afraid to buy a car. They don't know what will happen to the residual value of the car in a couple of years. Technological progress is so fast, etc. So it's a challenging commitment to really buy an electric car. And with a product like car subscription, you have basically no commitment. You have a commitment for 1 year. You have a monthly rate that you can plan. So it also lowers the barrier to entry and actually try out an electric car. And we found this a very cool component of the business to be an enabler of the electrification in the automotive industry.
I love that. Wonderful. And we are a Swiss podcast, so we are based in Switzerland. And of course, we bring in the Swiss perspective. We actually got connected through the NOAH conference in 2023 that happened in Zurich. And now we're here talking. And if we look only at the Swiss market alone, there are 2 startups offering a car subscription, basically. If you Google around and look at the German market, there are also other players besides Finn that are active in the market. And I just wonder, how do you sort of position yourself in a pretty active market environment, and how do you stand out from the crowd?
That's a very good question. And I think also when looking at the term car subscription, a lot of different topics are actually thrown into one basket. And there's different business models behind. So on the one side, you have, for example, software companies. They focus on building a platform and the software basically in the background to enable existing fleet operators to offer car subscription. So this can be, for example, a car dealer that has 50 cars on his parking lot and wants to offer car subscription. So there's car subscription companies that actually enable that. Then you have OEM-owned products. So many OEMs try to get a foot into the door and develop more towards mobility offerings by actually offering, for example, also car subscription. Then you have the rental car companies that see this basically as an addition to their rental car business and use the existing rental car fleet to also offer it for longer terms. And then you have I would say the players like Finn, more or less the full service provider that cover the entire value chain. So we really cover everything from acquiring the assets, operating the assets, being the demand generator, being the company that finances the car, basically the entire scope of the value chain. And I think this is the first very important aspect. So through this depth in our value creation, we differ basically versus among a lot of our competitors. But in the end, then, especially compared to a lot of the incumbent players, mainly OEMs or existing mobility providers, I think we have the opportunity that we don't have any legacy. So basically, we fully focus on car subscription. We can build our entire business model around this, all internal processes, all systems, etc. So I think we're able to actually offer this at a lot more efficient and to a certain extent also competitive way. And I think this is what makes Finn stand out. But then in the end, it's not like that we have a technical evolution or innovation that we're offering. We're mainly offering a service. So for us, it's also a lot about actually executing. And we're looking at this tremendous market opportunity, the market for cars in Germany, but also in many other European countries, is probably the largest industry in those countries. So market opportunity is large, and then it's not like basically only the one player that will survive in the end. But for us, it's mainly about being the one who executed the best to be the dominant player. And I think we managed to build this position in Germany to kind of be a well-established player by now, and actually also be recognized as the leading provider around car subscription.
Amazing. I think that's a very strong pitch. And at the same time, I also want to take the customer's perspective. And there, why for me as a customer does it make sense to actually have a car subscription compared to purchase the car, rent it, or lease it?
I mean, the main aspect for us is convenience and simplicity, but also transparency on the cost. And I think if you look at the traditional way of getting a car, you used to go to a dealer, buy the car, you have a different party to finance the car, then you have a different party who insures the car, you have additional partners for tire changes, maintenance, repair, all these different topics basically, and you have to want to be knowledgeable about it and also manage it to a certain extent. So what we're offering is very convenient and simple access. You go online, you find the car, you book it in 2 to 3 minutes, you get it delivered to your doorstep, and we take care of everything that can happen basically to you and to your car during the time that you use it. From a speeding ticket up to the total damage, you don't have to worry about anything. And on top of that, you have this monthly rate. And you can really plan around this. You know what a car will cost you, and you can also assess whether you can afford it or not. So you don't have any hidden costs, any additional payments at the end. So it's really about convenience, but also transparency in the end.
That sounds so simple, and at the same time also almost too good to be true. How do you make sure that your cars don't get wrecked? Because if I rent it from you, it's so easy, so fast, so simple, and it's not even my car. I would assume that many people are a bit more risky drivers compared to if they were driving their own car that they purchased with their own money. Do you have to deal with a lot of, damages or even total wrecks of cars because people are reckless drivers with the fin cars that they sort of subscribe to?
That's a very interesting question. So actually, I think there's two components to it. For us, it all starts with the underwriting process at the beginning to make sure that the customers that we take on also fulfill kind of the criteria that we have. It's not only about basically wrecking a car, it's also about coming up for your payment obligations, etc. And I think this is an area where we really learned a lot over time on what to keep an eye on, especially in an online world, on basically checking the background of people, but especially businesses, are more where fraud is easier basically to commit. But then what we saw during the lifetime is that we rent out a car for 12 months. It's not a rental that you use for one day. So people treat the car really more like they are owning the car. And also the damage behavior that we see is a lot closer to actually private users than it is to rent-a-car customers. So we don't have massive issues with that. However, it is definitely one of the challenging aspects of the business to communicate to a customer that basically damages that you cause to this oftentimes very expensive asset is something that you will need to come up for in one way or the other, basically at the end of the subscription period. Also, besides the insurance that we obviously offer.
But that's a really nice surprise that they sort of behave closer to an owner than a renter in that regard. That's really good to hear. And it also shows, again, the importance of your co-founding team and actually the processes behind it, right? You really need to do your risk mitigation or risk handling execution in a very professional and very good way. Can you tell us a bit more how these approval processes and sort of the whole knowledge and the learnings along the process worked out for you to get better and better at this?
Yeah, for sure. I think generally risk mitigation and also underwriting, as you mentioned, is relevant for us in various aspects. Maybe as a background, we have a B2B and a B2C business, and our customer base is split roughly 50-50. So this is the one important differentiation between customer types. And the second big differentiation is also that underwriting is not only relevant for us for our users, for our customers, but also for other business partners, especially for parties that we sell cars to, for example. But let's maybe start with the customers and the underwriting process there. Actually, it's straightforward, but I think a lot of the knowledge that we build really lies within the people and the details, basically. But how the process functions overall, when you go through our checkout process, we simultaneously run a credit check for you in the background, basically. So we already have an indication of your financial stability in the end, I would say. And then once you position an order, you basically also have to upload your ID as well as your driver license, along with, people probably know this from opening a bank account, etc. These online verification systems where you upload the documents, but also selfie of yours. And then we have an entire team basically that not only relies basically on the judgment of the provider that we're using, but also build up a lot of internal intelligence on what to watch out for and how to spot fake IDs, fake driver licenses, etc. So I would say for B2C customers, it's somewhat straightforward, and we have that very, very well under control. For B2B customers, actually, this learning curve took a bit longer because you have a lot of very small companies that don't really have a credit history. However, they can somewhat hide behind basically their GmbH or the company. So you have to dig a lot deeper to actually understand who are the people behind these companies, what is their intention, what are they going to use the car for, and then sometimes also run basically personal checks on the business owners or the people behind the company.
Yeah, that sounds like a bit of a more difficult task, indeed. And you mentioned before, you also have an insurance included in your subscription. Please tell us a bit more about the Fin insurance, how that works, and sort of what is covered with that subscription that I sign up for, and also what not.
No, for sure. So basically what we're offering to our customers is a fully comprehensive insurance as you would know it basically as a private customer as well. It does come with a certain deductible, which is €1,000 for us, for example. So basically any event is insured as long as it's like no fraudulent behavior behind, I would say, in general. So very straightforward from a customer perspective. In the background for us, we're partnering with large insurance companies, obviously, and we partially have different agreements to what we offer to our customers. So we might have a higher deductible towards our insurance carrier and carry more risk on our own, because I think it's important to differentiate between liability damages, where we are liable for damages our drivers did to other parties, and these can go into the millions, basically. So you want to make sure you're really protected against them. And then you have the damage to the car, which is always capped basically at the value of the car. And also with the fleet that we have by now, we have around about 25,000 cars in our fleet by now, it becomes very predictable. So over time, you can increase the risk that you take basically, and reduce the coverage that you take out from an external insurance company. And by that, obviously also optimizing the cost, because with an external insurance company, you always have taxes included that you cannot reclaim. You have a margin included for the insurance company, etc. So once you build up the track record and it becomes more predictable, you can also over time reduce the coverage that you actually take out from external parties.
I love that. It really shows the power of the operational excellence, how you then get more efficient and also better from a business perspective in almost all aspects in that sense.
No, fully agree. Especially this track record is very important for our business, as you mentioned in operations, but for example, also in financing, etc. It's really about building up a track record and building up credibility towards those large companies, be it an investment bank or insurance company. And this yields the opportunity to over time reduce costs and improve your margins or become just more cost competitive also on the market.
Right. So now we better understand how Fin operates and where you come from, how you were born, so to speak. There's one very interesting aspect. After you successfully started in Germany, you decided not to expand to the DACH region or Europe, but to directly go to the United States instead. Why was that the decision that you made back then, to go directly to a new continent and a completely new market?
That's also a very good question and something we get asked often. I think you have to understand the time back then. It was 2021. And we were basically, the first 2 years of Finn were tremendously successful. We had a very steep growth curve, basically. And at the same time, we were basically, in our opinion, in the most attractive market in Europe already. So Germany is the largest automotive market here. The opportunity is the largest. So we already set foot here. Also, the automotive industry is quite strong. So from all the partnerships that we built up, etc., we felt we are already in the most attractive market. And in order to have this additional upside for the business, we might as well jump to the globally most attractive market. And the US is still basically the largest market and the most attractive market in the space of the automotive industry. So market potential was certainly one very important aspect. The other important aspect is also that we felt an expansion will always be a huge effort. Also expanding to other European countries, like different languages, for example. Building up on-the-ground operations will need to be done over again, basically, in other countries. So if we take that effort of expanding to another country, we might as well do it in a country where the return is basically or the upside is very significant. And the third component for us was also, quite honestly, a bit from an investor perspective. We felt for our later stage financing, especially as we move to Series B, Series C, etc., most of these funds that are actually able to fund such a round are US based. So having that home turf advantage and being present basically in their home market for us was also very attractive, basically back then, to attract the attention, but also the appetite of US-based investors.
That sounds like the perfect combination. Everything you said makes perfect sense. At the same time, we all know with higher upside usually also comes higher risk. It's just the way the world works, right? Today, in 2024, you decided to leave the US market. Why this sort of turn back and say, no, now we go back and focus on Germany? What happened in these few years that you were there?
So maybe up front, I think we still believe in the high attractiveness and the potential of the US markets. For us, it's rather a temporary pause, basically, of our activities in the US rather than leaving the market for good. But as I mentioned, we took the decision to expand in 2021. And as we all know, basically, the world turned quite significantly back then. And a couple of factors that really also influence our business. We had spiking interest rates, basically, which is very important for our business. We had also a lot of dynamics in the automotive industry, especially coming from these. During COVID, you had supply limitation in the industry. Prices went up. Used car prices went up. And basically, we now, since 1.5 years, roughly see this strong market correction, especially when it comes to used car prices, where prices really drop. And on top of that, you also have the effects around electric mobility. Maybe some of the listeners also read about the price reductions that Tesla had, and also the price war this sparked around electric cars. So overall, the macroeconomic environment totally changed since then. And for us, basically, in these days, we really want to focus and strengthen our core business in Germany, which made up more than 90% of our global business. So it's really still the nucleus and the core. And we want to make sure we fully focus on basically growing the healthy German business and pausing the still cash intense US business up to a point where we become profitable and we can fund such expansions basically and investments through our own cash flows.
That's a big ambition. I hope you will get there one day. I think that's the perfect way to do it. Still looking back to this first try of the US expansion, what were the 2 or 3 things that you would do differently today, if any? Because it also sounds like it was pretty much of a market shift that was not that predictable. So if you were to change anything, what would you change?
Quite interesting. We actually did a lot of things different when we expanded to the US than we did it when basically successfully growing Finn here in Germany. And I think the 2 aspects that stand out for me is, first of all, team. In Germany, we basically, as I mentioned, we started with this group of co-founders. We all were responsible for our own domain department, basically, and we grew this organically. So being the first person on the ground, seeing what works, and then basically hiring and growing the team. Mainly with also young, hungry, very smart individuals that are mostly generalists and eager to solve a problem. In the US, we threw this aboard a bit and hired rather senior people that we expected to basically, to a certain extent, also do the job for us on the ground. A second aspect for us was also this establishing a company culture, basically, and making a business successful, in my opinion, comes back a lot also to kind of the role modeling of the founders, etc. And when we expanded to the US, we were still in such a steep growth phase in Germany that actually none of the co-founders relocated to the US to grow the business there. But as I mentioned, we mainly hired external people that came out from totally different backgrounds. And we were never really able to establish the company culture that we had here in Germany, also in the US. So if I would do it again, I would definitely make sure to send one or two of our co-founders, at least of the inner circle, basically, of the early days, over to the new country and make them responsible to actually growing the business there from scratch. And by that, ensuring that basically all of our, as I mentioned, the culture, but also the best practices, etc., are taken along with them. And then the second topic that I would do differently, we were, as I mentioned, very successful in Germany. So we also had very ambitious plans for the US, especially in our first year. And we also set this as a target, basically. And I think to a certain extent, we might have aimed too high and basically also planned a bit unrealistically. While in Germany, we basically started small and always, basically ventured our way up. So tried what works and then did more of what worked, but stopped doing what did not work. And in the US, we started with this very ambitious goals for the first year before actually finding this product market fit. And here, the first year in Germany was so important for us to try and experiment with different components of our product, with pricing, with different models and partnerships, etc. And we never really had this phase in the US and gave the team the time to find this product market fit again for a new country, because whereas the product itself is more or less similar, or was similar in the US, there are different components that just work different in the US, and also different consumer behaviors that work different. And I think you need to give yourself the time to actually understand these and also make the necessary adjustments before going all in, basically, on growth. This is what I would definitely do differently next time.
Super valuable learnings. Thank you so much for sharing these here. You touched upon the topic and the importance of financing multiple times, right? So your sort of business model is pretty capital intense. You need to finance the car, and then you basically have a subscription that people can use and then get access to these cars. So you need a lot of funding to get these 25,000 vehicles that you have out there funded. How do you do that? By at the same time not neglecting and giving away too much of your shares as a company, as a startup?
So when we speak about financing, we always differentiate between equity and debt financing. So equity is really money that we use to grow the business, and debt financing is money that we use to finance the fleet. And I think we have to differentiate those two, because in equity, yes, obviously we do give up a part of the company and we do give up shares. But on fleet financing, this is not our strategy. So we don't want to use equity to actually finance our cars. When we talk about debt financing for a bit, we mainly use two different instruments there. One is asset-backed financing with large investment banks to finance the fleet. And the other very important component is captive leasing banks of the manufacturers. And we use both instruments basically to finance cars, and roughly have 1 billion of assets basically in financing at the moment. Here, as I mentioned, I think the key component is really to, over time, build up this track record and then gradually increase the financing capabilities that you have. So expanding the facilities that you have and increasing the volume of those facilities. And at certain points in time, also have these step changes to improve the economic conditions of the fleet, be it, for example, our interest spread. And It was very challenging in the beginning because when we raised the first facility of 500 million back then in 2021, we had almost no track record. So we have never proven that we are able to buy a car, bring it into a subscription, maintain the condition and not get it wrecked, as you mentioned, and then sell it again for the price basically that we planned for. And this predictability and planability is very important for banks because that's also kind of the risk that they attach to you, and that's how they price their product. So we started with the first cars and then over time built up this track record. We went through the first cycles, basically the full cycle of a car, and are now at the point where I think we figured out how it works. And we're also able to prove that we can manage this entire cycle of a car. And I think are now in a very good position to actually improve the economics of our financing.
I do have a quick follow-up question, if I may, here, because this is so interesting. With your focus on electric cars, you also have the battery, right? That makes a big part of that car. In what way does that also influence the cycle of a car, as you described it, on when you buy it and when you also want to sell it? Because I can imagine that if you would hold on to the car for too long and it's heavily used, probably the value, including the battery capacity, decreases quite drastically. How does that play out in your model?
Yeah, that's a very good question on the holding periods, as we call it. So how long do we keep a car in our fleet? Maybe one note up front. To my knowledge, actually, the decrease of battery capacities is not as drastic as it was anticipated. So when you look at, for example, Teslas, etc., that are 1, 2, 3 years old, they still have the majority of their battery capacity. So this decline is not huge. However, what you see that the technological progress is just so fast and the range of cars basically gets extended so fast that 1.5 years ago, there were cars offered with 150 kilometers of range, etc. By now, you see cars with 600 up to 800 kilometers of range. And who wants to buy a car with such a limited range, basically, if there's already significantly better alternatives on the market? But what we do to mitigate this risk of technological progress is basically, first of all, shortening our holding periods. So most of the cars we only keep in the fleet for 12 months. This already gives us a certain predictability, basically, on the residual value after 12 to 18 months. And the second point that we do is we kind of hedge the market risk by what we call pre-selling our cars or forward sales agreements. So at the point when we buy a car, we already sell it to a third party or close an agreement with the manufacturer to take the car back after 18 months, for example. And this for us gives us full transparency, but also planability on the depreciation. So we already know what to plan with and how much loss in value the car will have over this 12 to 18 months typically.
Wow, that's really fascinating. So technically, of course, you're a tech startup. Of course, you have a car subscription, but basically you are a technology-enabled asset manager, so to speak.
We do have a lot of aspects that would also qualify for a fintech, I would say, overall. But I think this is fascinating to a certain extent because I think when you look at our product from the outside, it sounds so simple, basically. You rent out cars for 12 months and you offer all the services around it. But I think if you look underneath our business model, and I think this is also one of the aspects why it's actually so difficult to replicate what we built. There are so many aspects that need to come together. You have that demand aspect of you need to build an e-commerce platform and attract the right customers for B2B and B2C. You need to finance these assets. You need to basically build up the supply collaborations with OEMs and really get their trust, basically, to also get access to the supply. And then you have this operational aspect of it where we can't just rely on 3PL providers like other companies that send out shoes, for example, do. But a car is a different thing. So a lot of the processes around logistics, etc., you also have to build up. And I think the combination of all of this really does make it a quite complex business, which also makes it difficult to replicate.
Right. And I'm sorry, I interrupted you before. So now we were talking about sort of the asset-backed or debt financing part, but there's also the equity part for you to invest in the company and in the growth of the company. How are you set up in that second part?
So we closed we're at Series C stage now. So we closed our Series C end of December last year. Our initial seed round was in 2019, and in between we had basically 4 financing rounds, bringing us to Series C. I think we raised an overall roughly 250 million in equity. Initially, basically, we were backed by a lot of well-known German VCs back then. And I think over the upcoming rounds, we also heavily built on their network to bring in new investors for the next rounds, basically with a different focus, being able to, from early stage startup to basically growth investors up until now, to also support the different stages of the company and have the right profile as an investor for what we also need, basically. So you also mentioned the topic of dilution. Obviously, we dilute, but I think as long as the business is growing and the cake basically gets bigger and bigger, I think this is acceptable for us. First of all, because I think the financial motivation is of course an aspect of entrepreneurship, but it's not the most decisive factor. And secondly, as I mentioned, as long as the cake grows, it doesn't matter if you get a share of the cake. I think the absolute payout basically is still attractive.
Right. And the cake, aka the company, are you already profitable?
Not yet. This is the big goal actually for 2024, and I think we're on a good path towards that. But our goal is to become profitable latest within the next 12 months. We target by the end of this year. So this is definitely the big milestone to also become independent of additional equity financing in the future. Because we strongly believe this will totally change the course of things, and we become a lot more independent, basically, once we're not reliant on external investors and fresh capital anymore. So we're really looking forward to that, and basically to do everything in our power to actually get there very quickly.
Fantastic. So profitability in the short term, maybe back to the US in the midterm. What else have you planned for the future? What are sort of the important milestones? Potentially an exit or even an IPO one day?
Yes, that's on the long list. We don't have a specific idea of the timing, basically, or we don't want to set ourselves. We're somewhat flexible there, but IPO readiness is definitely something that we are now looking into and basically try to push over the next couple of months and years to be ready for an IPO. Hopefully end of 2025 latest. And then it will also depend, obviously, on our growth, but also on the market conditions when the right time has come. But at least being in a position to do so is something that we are getting ready for. Other than that, we are, with the experience basically from the US, also look at European expansion starting next year. And then obviously growth in our home markets. As I mentioned, the market potential is still so huge, and we're just a fraction basically of the overall market. So there's so much opportunity, and our goal is to significantly grow the business basically with what we have today in our home market as well.
So you'll be busy over the next few months and potentially even years. I see that.
Yeah, too little work was none of our problems in the past, and obviously also will not be in the future.
So to wrap up today, Nikolai, I also have some rapid fire questions for you. I gave you just different options to choose from or a quick question, and you can answer ideally in one sentence, but if necessary, also a bit longer, no worries.
Okay.
The first one, what car are you driving right now yourself?
Hyundai Ioniq 5 since 2 weeks. Used to drive a Tesla before.
Nice. And what is your favorite car of all time?
Oof.
Doesn't have to be electric, but of course can be.
I would say probably still the Porsche 911.
A classic, a German classic in that sense.
Yeah, very timeless, very timeless.
What has entrepreneurship taught you so far?
A lot. Hard to answer in one sentence, I guess. But what it told me, I think, is responsibility as well, because you're responsible for, first of all, investors trust your money. You have employees. By now, we're over 300 people that are responsible for, but also the joy aspect of it. So you can create a product that really is attractive to other people that pay money to use it. So it's also very rewarding. I just came back from vacation in France, and if you see like a Finn car parked next to you in the middle of nowhere in France, this is quite rewarding. So I think it's a lot of responsibility, but also a satisfaction to a certain extent, because a lot of the hopes that I mentioned in the beginning became true.
Exactly what you were looking for. And if you weren't a startup founder today, what would you be doing instead? Maybe consultant or something different?
If I wouldn't look at financial motivation, I would probably be do something with my hands. So basically be a craftsman in some aspect or so. I really like to fix stuff at home, work with wood, build own furniture, etc. So if I wouldn't look at the monetary aspect of it, basically, I think I would rather be in that space.
Nice. And the last question for you today, we heard immense sums, 25,000 cars, a lot of financing, like 250 million, a lot of debt financing the actual assets, and also, of course, employees and customers that you are responsible for. How do you stay afloat and also sort of take care of yourself and don't go completely crazy because of all the pressure on you?
A good team, I think, to distribute the workload and also distribute the responsibility, but always have someone to also jointly tackle those challenges. Family obviously is very important. I have a 1-year-old kid by now that gives me a lot of energy and joy. And I think sport is very important for me personally to just clear the head from time to time.
What is your sport of choice?
I used to be a basketball player. Unfortunately, this doesn't work out too well with the team sport anymore. So by now I do anything from running over tennis to golf, cycling. So a lot of different things. I like sport of any kind.
Nice. Nikolai, thank you so much for coming on the show. It was a pleasure, a lot of fun, and very insightful to talk to you today. Thank you for your time and for all these amazing lessons that you shared with us today.
Thank you for having me. It was a pleasure.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.